Hi, I'm Myles, founder and CEO here at Flying Colours. In each of these videos, I talk about a specific theme and why it matters when it comes to investing your money. Today, we're going to be looking at diversification. What it is, why it matters, and how your advisor takes diversification into account when deciding how to best invest your money. Diversification is particularly important to consider at the moment. Most investments are doing well, so it is tempting to buy more of what is already working. But many a happy retirement has been ruined by this approach. But instead, we need to think about doing well in all weathers, not just today's. As ever, if you enjoyed this video, please do like and share it. So here we go, diversification. This is one of the most misunderstood concepts in finance, in my opinion. It's one that all our advisors will take time to explain and really want you to understand. When we're looking at a diversified investment strategy, what we're looking for is a good mix of investments. We don't want to invest in just one country or one sector, but we also want investments that react differently to broader economic conditions and significant global events like the recent US election. The more the investments have in common, the higher the risk of the strategy. The less they have in common, and the less risky the strategy. Assessing how much risk you are willing to accept with your investments, known as your risk tolerance, and tying that to your end goals when it comes to your finances is one of the most important conversations you will have with your advisor. So, building an all-weather portfolio. Our goal is to create a basket of investments that truly complement each other. It's important to understand that not all of the investments will do well all the time. That's impossible. But overall, the basket should grow in value no matter what the broader economic situation is. The goal is to protect your money from sharp drops that could take years to recover from. At the same time, we want to make your investments grow over the long term. Please remember that your returns, if they come without risk control, is as bad as risk control without returns. There are two parts of any successful investment strategy. Exploring the investment universe, let's look at that in more detail now. So now we know that in your investments, we need a mixture of different things. And not all of those will do well all the time, but overall the basket will rise in value, or should do. The central problem for diversification is to minimize the effects of the global economy and its twists and turns. A properly diversified portfolio needs to be able to withstand recessions, inflation, and shocks from things that affect us all, like the oil price or geopolitical uncertainty. The ideal portfolio should explore the entire investment universe, everything from traditional investments like stocks and bonds to alternatives like property. As you'll see here, each of these investment types or asset classes behaves differently depending on economic conditions. During periods of economic growth, assets like stocks and high-yield bonds tend to perform well. Profits rise, company valuations increase, and investors see good returns. However, these assets also carry large risks, especially if the economy turns unexpectedly. Stocks have historically suffered big losses during downturns. For example, during the 2008 financial crisis and the 2020 pandemic, equities saw sharp drops of over 30% in their value. On the other hand, have a look at this chart. Now, government bonds tend to shine in times of economic downturn. When central banks cut interest rates to stimulate the economy, bond prices typically rise. But this is not always the case. During inflationary periods, when things cost more and interest rates are likely to rise, traditional bonds may also struggle. Have a look at this chart. It shows that in 2022, when inflation surged, bonds, usually a safe haven, failed to protect investors. Rising prices ended up eroding returns. But assets like commodities, real estate, and inflation-linked bonds can help protect against rising prices. And commodities like gold and oil also often go up in tandem with price surges. These types of investments can act as a safeguard, adjusting automatically to protect against inflation. What all this highlights is the importance of understanding the nuances of each economic environment. That's why true diversification is about more than just holding different assets. It's about understanding how those assets behave in various conditions. Thank you for watching. If you have any questions about today's video, please get in touch. Just email me at hello@fcadvice.co.uk. And finally, as ever, I've been talking about investing, which means that your capital is at risk. Thank you.